Okay, so let me ask you this. Predict or prepare? Be early or be one with the trend? What about the risks and how to think about the second order impacts? Well, when in doubt, read Howard Marks' Memos, right? Good evening, ladies and gentlemen. I'm Aanchal Almal, the PL co-chair for the Mumbai chapter of the CFA Society. And on behalf of the CFA Institute and the CFA Society India, I'm incredibly thrilled and honored to welcome these distinguished guests to today's session with one of the most astute minds in the industry that we have. But before we dive in, I would like to call Mr. Shamit Choksi, the director for the PL Committee for CFA Society India, to introduce the session and the guests for us, please.
Thank you, everyone. After a long time, we're seeing more than 650 people in this room. I think it's been more than many years at CFA Society, so thanks so much for this one. It's thanks and gratitude, thanks to Mr. Howard Marks that we made it happen. So dear members, guests, charter holders, candidates, and a lot of our invitee guests as well, thank you for patronizing our events. And this introduction is just to warm up the audience and possibly close the doors as well. But essentially what's happened is, you realize this year has been quite interesting for CFA Society professional learning events. And if you notice, our focus has been to move towards global thought leadership, focus on improving the competencies of the money managers who go back and manage money at their day jobs. So I think this event is essentially for professional investors who believe they can take back something interesting from the amazing thought leadership that we have today here in the forum. From a society perspective, our endeavor is to sort of upskill people and connect experts and enhance competencies continuously. In terms of the board and volunteers, I must thank all the volunteers and the board members for allowing us to function in a way that allows us to host large-scale events. And this is one of them. So clearly, great work done by all the volunteers of CFA Society India. And moving on quickly to today's session, so today's event, a dialogue with Mr. Howard Marks, it's sort of I would say a labor of love and commitment from the board and the volunteers, because we've always been keen to have Mr. Marks at our forums. He's come earlier in 2017. At that time, sir, we had people standing or even sitting on the carpets in the absence of space. But I think we've improved from there, right? We've done well. So yeah, we have a 650 plus audience today. Doesn't look like it because of the huge place. But I think going back to the context of the event, I think couple of quotes always sort of influence me from the books that he has authored. And, I think most important is, good times teach us only bad lessons. And experience is what you get, when you didn't get what you need or what you wanted. I think the most important one that I felt close to was being too far ahead of your time is indistinguishable from being wrong. I'm sure a lot of you must be arguing with your bosses at office, and this might be the one to use, I think. But yeah, definitely the learning from the books is far from the investing world. It also impacts your personal life, I think. It also impacts the way we think about other things in life. I think that's the beauty of the amazing learnings we get from his books and his memos. So again, it's indeed my pleasure, and I would say great luck to introduce the legendary investor and author, Mr. Howard Marks, as a speaker of today's session. And may I request Mr. Howard Marks to please come on stage. Since the formation of Oaktree in 1995, Mr. Marks has been responsible for ensuring the firm's adherence to its core investment philosophy and contributing to its big picture decisions in investing and corporate direction. And outside of his professional career that we all know a lot about through his books and through the markets, Mr. Marks is a trustee and advisory member of the investment committee at the Metropolitan Museum of Art. He is a member of the investment committee of the Royal Drawing School in London He also serves on the Shanghai International Financial Advisory Council and the advisory board of Duke Kunshan University, and is an emeritus trustee of the University of Pennsylvania, where he chaired the investment board for more than 10 years. Mr. Marks holds a BS Economics degree cum laude from the Wharton School at the University of Pennsylvania with a major in finance, and an MBA in accounting and marketing from the Booth School of Business at University of Chicago. But most important for all of us, he is also a fellow CFA charter holder. I now welcome the moderator for today's session, the extremely diligent private alternatives investor in India, Venkat Ramaswamy, Managing Director and CEO of EAAA India Alternatives Limited. Venkat, I'm very glad to have you again at the society, I think just in a span of 18 months. So great to have you here. Venkat obviously has 3 decades of experience in financial services. He's been a driving force in transforming Edelweiss Financial Services, and he holds a bachelor's in electrical engineering and an MBA at the University of Pittsburgh. A lot of astute global institutions, pensions and insurance funds have been dealing with his office. So obviously, we really love Venkat whenever he's here at the society. Thank you, Venkat, for agreeing to moderate this very challenging session. In terms of, I think the slideshow, I think it's going to be a Q&A session, but I think you have the QR codes for Slido, so please do punch in your questions on Slido, and we hope that some of those questions make it on stage. Last but not the least, after the session, we have a sundowner networking event at this venue, so members and guests feel free to network and enjoy the evening. With this, I wish everyone a productive and fruitful evening and networking. Over to you, Venkat. Thank you.
Thank you, Shamit and Anchal, for having me moderate this session. Ladies and gentlemen, it is a rare privilege for all of us to be sitting and chatting with one of the brightest minds in the investing world. Thank you, Howard, for giving us this pleasure. What brings you to India?
Well, I'm very pleased to say that my friends at the GIC of Singapore celebrated their 15th anniversary in India last night and asked me to speak there, which was a great pleasure. And then tomorrow I head to Hyderabad to break a coconut for the opening of our Hyderabad office, which we're very excited about. So it's a terrific time for me to be here and to see so many members of the society. It makes it a wonderful trip.
Thank you. So I wanted to start by asking you, how do you feel about this fact that it has almost become required reading for any serious investor globally, your memos, right? So, and how do you exactly make these memos, which has so much information, so simple to read?
Well, first of all, before I answer your question, I want to thank Samit and Shal and yourself and all the members of the society and the volunteers who worked to put this together, and for your kind invitation. As you know, I was last year, 8 years ago, this week, first week of March, and met with the society and had my first trip to India, which was thrilling. Wrote a good part of my second book, Mastering the Market Cycle, while I was here in India because my wife didn't come. And she said, I don't feel well enough to go, you go. So I went by myself. I had my evenings free as a result and got a lot written. But, you know, Venkat, when I think back to the beginning of the memos in 1990, I didn't have a grand plan. I didn't say if I write the memos, we'll do some business or, you know, I'll get a following or ever. And certainly I never anticipated the things that have occurred. But I had a seminal event and I just wanted to tell people about it. I just wanted to write about it and share my view. And it was a very, very important client dinner that went a long way to develop the philosophy I've followed since. And I just thought it was worth writing about. I wrote one in 1990. I wrote another one in 91. I think I probably wrote the next one in 94. It wasn't a regular thing, but, it took on a life of its own. And then after 10 years of writing the memos, I wrote one on the first day of 2000 called Bubble.com, which talked about excesses that I detected in the tech stock market. And that one had two pluses. It was correct, and it was correct fast, because Shamit talked about the fact that being too far ahead of your time is indistinguishable from being wrong. I wasn't too far ahead. So that one got some attention. And I said in the introduction to one of my books that after writing for 10 years, I became an overnight success. So it really shows the importance of persistence. And the answer is, I think that I was always writing for myself. I wasn't writing to accomplish some external goal, but merely to write down my thoughts. And also, I enjoy it greatly. And if you look at the memos, there's usually one published in September, and there's usually one published in January. And what that means is I wrote over the summer and I wrote over Christmas, and I'd rather be writing than not. It's a thrill to me to have people read them and incorporate them in their thought process, and to have people tell me that I influence their thinking is a great thing.
Thank you, and please don't stop writing them.
I have no plans to stop.
Thank you. So, what are the biggest challenges that you have faced when you founded Oaktree, co-founded Oaktree with Bruce, Cash, and others? It is now, a month away from 30 years?
Right.
And what are the key learnings of what makes a fantastic franchise?
Well, it all came together for me. Bruce Karsh came to work for me in 1987. We've been partners ever since, 38 years, very harmonious. I wrote, my first book was called The Most Important Thing. That sprung from a memo that I wrote around 2002 with the same title. In the book, as in the memo, there are 21 sections, and each one says the most important thing is, and then it's something different. Because there is, in our field, which is so complex, there is no one most important thing. There are many most important things. And I said in that first memo in 2002 that the key to a successful partnership is shared values and complementary skills. And I found that with Bruce and my other partners. And when we started Oaktree, we came together at TCW, where we all worked, and on average, we worked together for 9 years before we started Oaktree. So starting in 86 on average. And we shared values, and that was very important. And then when we started Oaktree, we wrote down our business values, not merely our investment philosophy, but what connotes the organization that you want to lead and the place you want to work. And we put that down. It was very important to us. We had goals that went beyond just making money. And to us, to me and to my partners, just making money is not enough if you make them in a bad way. We had a definition of the kind of firm we wanted to have, and we set that down, and I think we accomplished that, which is great. But I think we had an efficacious investment philosophy, which we've stuck to very diligently and guides everything we do. And then we got lucky, as you and I have discussed, the importance of luck. When we finished at TCW in March of '95, before resigning, we managed $7 billion. That's about the size of,
Yes.
and you're on a great path. And the one thing we never did when we were planning Oaktree is we never wrote down a profit plan or a budget or any sense of, I don't believe that much in planning. You know, there's a saying that man plans and God laughs, and I believe it. So prominently, the one question we never asked is whether we would ever get back to $7 billion. And we just thought that we thought we were doing good work for the clients, and if we continued to do good work for the clients, we would have a successful enterprise. And that was enough for us. And so we set about doing it. And then we got lucky, because when the tech bubble burst in 2000, the S&P was down in 2000, 01, and 02, the first 3-year decline since the Great Depression. And people lost interest in the stock market. The Fed cut rates to fight the recession, and yields were low, and people lost interest in the bond market. And if it's not stocks and it's not bonds, what is it going to be? Well, let's invent another field, and let's call it alternative investments. And it turned out that that's where I had been since '78. So I never said this is what's going to happen. I was there at what turned out to be the right time, right place. So as opposed to wondering whether we would get to 7 billion, today we're at 200 and change billion. I think we did a good job, but we got lucky as to the appetite. So it's been a wonderful ride so far.
Yeah. And the importance of randomness and luck.
Yes, yes, very important to me.
So in your book, Mastering the Market Cycle, you talk about the need for an investor to have a feel, any investor to have a feel of which part of the cycle the market is in.
And
Why is the understanding of market cycle so important? And given the current volatile and complex macroeconomic environment all over the world, where do you think in the cycle we are?
okay. I think we operate in the investment environment, and it prescribes and defines what we can do on a given day. And there are times when the investment environment is ripe. It offers great opportunities, and you can make a lot of money without taking too much risk. And those are times when you should plunge ahead and act very aggressive. There are also times, based on the behavior of the cycle, when opportunities are few and pursuing them aggressively results in significant risk. There are times when it's easy to make money with low risk. There are times when making money is challenging and requires acceptance of high risk. Obviously, it's essential to know the difference. I think that the most important decision we have to make in a short to medium term sense is how to vary our posture, how to vary our balance between aggressiveness and defensiveness. Each of us should understand ourselves, and perhaps more importantly, we should understand our clients. And we should understand for each client and for ourselves what is the right place on the risk-return balance to operate. And gaining that knowledge is a very important job for us to do consciously. And then, if we're aware of what's going on in the environment, we can say this is a time to amp up our aggressiveness, and this is a time to increase our defensiveness. And the only way to do that is through an awareness of where we stand in the cycle. I don't believe in foreknowledge. I don't believe in forecasts. I inveigh against macro forecasts. We never know where we're going, but we should know where we stand. And where we stand tells us something about what I call the market's tendencies, what the market is likely to do. I never know when it's going to do it. And, I can conclude that we're in dangerous territory, that things are risky, that prices are elevated. That doesn't mean they're going to go down tomorrow. They can continue to go higher. And the risk taker can continue to make money in that environment. But I think the likelihood is that there's a decline out there someplace waiting to happen. And the higher the market goes, the more likely it is, and maybe the sooner. So I think that an understanding of where we stand in the cycle is incredibly important for those who want to vary their behavior tactically. There are people who say, no, I'm a buy and hold investor. I'm going to do that regardless of what happens, and that's fine. But I think it's desirable at the extremes to vary, and we try. We say we're not market timers, but we try on the rare occasions. As I was writing the book, Mastering the Market Cycle, I consult with my son. He's my greatest advisor, my son Andrew, and he's a professional investor, a venture capitalist. And I said to him at one point in our discussions, I said, I think my market calls have been about right over the course of my career. And he said to me, your son will tell you things others may not. He says, yes, Dad, that's because you did it 5 times in 50 years. And, there's a saying, out of the mouths of babes. 5 times in my career at that point, which was 2017, 5 times I had seen the market crazy high when it was dangerous and everybody else was streaming in and pushing prices further, or when the market was crazy low and prices were giveaway levels and everybody was exiting. And when you see the market at a crazy extreme and you understand the nature of the investment climate, I think the argument is compelling and the probability of being successful is high. But what if I had tried to do it 50 times in 50 years, or 500 times, or 5,000 times? I've been doing this now for 56 years, which is, let's say, 19,000 days. What if I had made 19,000 predictions? My guess is that at best, my record would be 50-50. Because when the market is 5% overvalued or 5% or 10% undervalued, if you make a pronouncement, your chance of being right approaches 50-50. It's only at the great extremes. So I think it's important to be macro aware and cycle aware, but I don't think there are opportunities to profit from it very often other than at the great extremes. Where are we today, you ask? Well, I'm a little schizophrenic because I go back and forth between talking about cycles and talking about pendulums. And of course, as I say in the book, if you take the pendulum off the wall, pendulum swings like this, you put it on the table, it continues to swing. You take a piece of paper, you draw the paper through, and the pendulum is swinging. What do you get? You get a cycle. So it's really the same thing, but for some reason, I tend to think in terms of the pendulum when I think about investor psychology. And the second memo, 1991, was entitled The Pendulum. And it talked about the fluctuation, how people swing from fear to greed, and from optimism to pessimism, and from skepticism to credulousness, and from risk tolerance to risk aversion. And of course, they swing in the extreme. That's the important thing. And in real life, things fluctuate between pretty good and not so hot. But in investor psychology, it goes from flawless to hopeless, like crazy. And so I engage in an activity I call taking the temperature, trying to gauge whether the market is overheated and people are too avid and too eager, or whether it's frozen and people are too reticent. I want to buy when others are reticent, and I want to sell when people are avid. Where are we today? Well, I think that, I think that we're on the optimistic side. I think that back in, we came out of the pandemic very confident, and 20 was a very strong year in the markets, which is kind of crazy given that we had one of the worst macro events of the last century. But the markets did well in 20 and very well in 21. But of course, inflation was brewing. And at the beginning of 22, the Fed decided to raise rates to fight the inflation. And most people concluded, and history showed, that most of the time when the Fed embarks on a rate increase program, it produces a recession. So what people said was, well, we have inflation and that's bad. And we have a rate increase program and that'll probably produce a recession and that's bad. In other words, it's all bad. And that's the way people get when I say that we swing from flawless to hopeless. So people became hopeless in the middle of 22. 22 was one of the worst years in history for stocks and bonds. It was, they say, the worst year in history for the 60-40, passive portfolio. And in mid-22, the pessimism was very high. Since that point, there's been a strong swing toward optimism. At the end of 22, people concluded that the Fed would probably cut rates, and that would revive the economy. Although they didn't cut in 23, by the end of 23, everybody was sure they would cut 6 times in 24, and of course they began to do so. They also concluded that we were going to have a soft landing, and that we would not have a recession despite the interest rate increase program. And so, psychology took a major turn to the better. We have a stock market rally that began roughly October of 23, and now has continued through 23 and 24, and 25 was good until recently. But I think there's been this strong swing toward optimism. And when you get that, you get higher prices, lower prospective returns, more risk, more competition to make investments, which drives out opportunity and drives out safety. People, the investment markets are an auction place. And, when they put up a Picasso for sale, it goes to the highest bidder. Yeah. And the same is true of investments. And when people have a lot of money and a lot of eagerness and a lot of optimism, the highest bidder tends to bid high and get the investment. But when you win the auction in a heated auction place for investment opportunities, what do you bid with? What's the currency for bidding? And the answer is that the investment opportunity goes to the person who is willing to accept the lowest prospective return with the least safety. And that's why it's so important to take the temperature. We're not there yet, but we're on the way. And we're not in a pessimistic market, we're in an optimistic market. And we can see the great, we too deal in credit. And when you're not a stockholder, I think there are two basic asset classes: ownership assets and lending. And the great advantage that the lender has is that our transactions are contractual and our returns are contractual. We give somebody money and they promise to give us a certain amount of interest every 6 months and then give us our money back at the end of the term. And we can compute with certainty what the rate of return on our investment will be, assuming they pay. The equity investor, the purchaser of ownership assets, stocks, companies, buildings, and so forth, natural resources, they can't calculate their earnings. We know what our returns will be. It's a mathematical issue. And so we can read in that where we stand in the market. Mid to late 22, pessimism was high. U.S. high-yield bonds yielded 9.5. That was a bargain. That was a great opportunity. You know, the S&P has returned 10% a year for the last 100 years, and that was enough to turn $1 100 years ago into roughly 14,000 today, so not too bad. We could get almost the same return on a contractual basis from a high-yield bond in the second half of 22. Today, that number is 7. So the fact that the promised return has fallen connotes the fact that the price has risen because of spirited buying. That tells us the opportunities are not as great, the risk is higher, time to ease off the gas pedal. So that's where we are. And I wrote a memo called On Bubble Watch, January the 2nd. It was the 25th anniversary of my first successful memo, bubble.com, January the 2nd of 2000. Because, you know, everybody asked me whether we were in a bubble, and I think we're not in a bubble. I think the prices are high, but we don't have the manic behavior, which is usually part of a bubble. We don't have the irrationality and the price insensitivity to the same extent. So I would say prices are lofty, but not nutty. Sorry for the length of my answers.
In the sense that Indian markets have fallen a little faster in the recent past, and so a lot of the equity investors are wondering whether we are still in the optimism phase or not, in the sense that, but we will see. Yep. So you've been in the industry for, like you said, more than 50 years. And you're still traveling around, writing memos, visiting clients. How do you do this with so much passion and interest at work?
Well, you know, first of all, I'm blessed with good genes. And I spoke on a panel for Warren Buffett's NetJets, and the person who spoke before me was a geriatrician, and he talked about the sources of long life, genetics, diet, exercise, not smoking, etc. So Buffett comes out on the stage, and he says, you know, they told me that the best predictor of how long you'll live is how long your parents live. And when I heard that, I got my mother an exercycle. So, you know, the truth is, I was blessed with good genes. I didn't do anything to deserve it. I led a pretty healthy life. Like many of you, I eat a lot of vegetables. But you know, I'm able to do it physically. But the other thing is that our business is so fascinating. And if you think about these concepts thoroughly, it's very rewarding. And I find that the more I think about the mysteries of the market, the more I figure out. And it's kind of like an archaeologist with a dig. And as you dig, you encounter subsequent layers of relics or disclosures. And that's the way I feel. And the longer I dig in these topics like risk and psychology and things like that, the more I think I understand, and it's incredibly rewarding. And I come up with things all the time. I wrote a memo in October about asset allocation, and in which I said, we all hear about big stocks, small stocks, growth stocks, foreign stocks, U.S. stocks, value stocks, all kinds of stocks, and then private equity, public equity, credit, natural resources, and all this, emerging markets, developed market. I said in there are only two asset classes, ownership and lending. And they have completely different profiles. Well, that's not the important thing. The important thing is it's just thought I never had before. So you can get to my age, and I'll be 79 next month. I'm still discovering new things. And what could be more exciting? Should I stop work and sit on a park bench? Should I play golf for 5 hours a day and drive, or should I stay home and drive my wife crazy? So I'd rather be out visiting with people, writing memos. And when, I can't tell you how many times I've been writing a memo and I've written something that I never thought before. It just comes, And so this is what we should all be doing. It's not the number of years in your life, it's the life in your years. And for me, I can maximize the life in my years by continuing to think.
Amazing. Going back to memos, so further thoughts on sea change.
Yes.
You have basically said that all this high, we are now seem to be in this higher interest rate regime after a decade and a half of extremely low to interest rates. And I think even in India, there are only expectations of shallow rate cuts in India at this point of time. How should an allocator or an investor think about asset allocation in this new normal?
Sure. Well, it's a big topic, Venkat, but I'm going to give, for the benefit of the audience, they haven't all read the memos like you have. But and by the way, I've made reference to the memos I've written, and if you want to read them, they're all available on Oaktree website, which is oaktreecapital.com, under the heading of Insights, Howard Marks memos, and I can assure you that the price is right because they're free.
Yes, easy to find.
And there's 35 years of memos there, and you're welcome to read them if you have some spare time. In the fall of 22, I resumed my international travel, and my partner Bruce and I made a trip to the Middle East, and we sat down and talked to clients about what we thought was happening, and spontaneously, without rehearsing it or planning it, we started to talk about what was going on in rates. And I came up with this conclusion that we were undergoing a sea change. To go back to history, in 1980, I had a personal loan outstanding from a bank, and I got a slip of paper in the mail. You remember the mail. And the slip of paper said that the rate on your loan is now 22.25. And 40 years later, in 2020, I was able to borrow personally at 2.25. So my rate went down by 2,000 basis points fairly steadily over a 40-year period. And since I was traveling at the time that I was having these thoughts and writing the memo, I compared it to the moving walkway at the airport. And you get on the moving walkway and you walk at your normal pace and you make great progress over the ground and you say, boy, I'm fit. It ain't you. And I believe that the decline in interest rates over that 40-year period was the most significant event in the financial world in the last half century, but it is underrated because it was gradual and took a long time. Mm-hmm. But if you think about interest rates, declining interest rates are very beneficial. Of course, they stimulate economies, they make companies more profitable, but importantly for us as investors, they increase asset values because the value of an asset is the discounted present value of the future cash flows. And if you reduce the rate at which you discount the future cash flows, you raise the present values. So declining interest rates produce higher asset values. My partner, Sheldon Stone, who's my longest living partner, we've been partners now 42 years. He goes around the office all day doing this. What does this mean? He's a bond guy. Rates up, price down. Rate down, price up. That's the way it works in the bond department. It works every place, but a little more subtly. And with bonds, it's mathematical. It's almost mechanical. But it's true of all asset classes. If you want to have a building that throws off $1 million of rent a year in a 10% environment, it's worth one thing, and in a 5% environment, it's worth something else. Where rates go down, the building price of that building with its $1 million income stream, it goes up. So declining rates are very beneficial for the investor, and obviously beneficial for the borrower because the cost of capital declines. Well, what if you own assets using borrowed money? You get a double bonanza. That's the definition of private equity. And private equity has the advantage that it was invented during this period of declining rates and lived through a period that was perfect for it. So it produced great returns. You know, you sit there and you find a company. You say, I think if I buy this company, I can make 10% a year. And then your capital markets person says, we can borrow the money at 8. You say, I can borrow at 8 and invest at 10, let's go. So you make the investment and you think you're going to make a good return. But then rates come down. So rather than make 10, you make 12 on the company. Rather than pay 8, you pay 6. Now you've borrowed at 6, you invested at 12, you say, boy, I'm smart. And that's the history of the last 40 years, in my opinion. What if it's over? That's the idea of the sea change. And I believe that if you came into this business since 1980, I imagine most of you did, all you saw for 40 plus years was declining or ultra low interest rates or both. And as Venkat says, the memo, Sea Change, December 22, primarily talks about the period from the beginning of 2009 when the Fed took the Fed funds rate to 0 to fight the global financial crisis, to the end of 21 when it gave up on keeping rates low and had to raise them to fight inflation. 13 years. Over that period, guess what? I was surprised when I did the research to learn that in that 13-year period, the Fed funds rate was 0 most of the time and averaged about 0.5%. My conclusion when I wrote the memo is that that's over. And you say in your question, what about these higher interest rates? Today's rates are higher than they used to be. They're not high rates. If you look at the 70-year history of the Fed funds rate, it averages about 5. So we're actually on the low side today. And I've seen, of course, 20% Fed funds rate. So this is not high. And everybody says, oh, you mean higher for longer? This is not high. This is normal rates. And I think we're going to stay in roughly this neighborhood, zip code, for the next 10 years. And so the norm over this period will not be declining rates and it will not be ultra low rates, which means that maybe different strategies will be the most successful. You know, Einstein said that the definition of insanity is to do the same thing over and over and expect a different result. I believe another definition of insanity is to do the same thing in a totally different environment and expect the same result. I believe we're in a fundamentally different environment for the next 10 years, at least. And the strategies that work the best in the declining and ultra-low interest rate environment will not be the ones necessarily that work the best or have the same margin of superiority in a period of stable and non ultra low rates. And I think that's just where we are. And, you know, credit today, the things we do in the States, liquid credit offers returns in the 7 to 8 range and private credit in roughly 9 to 11. And as I said before about the S&P, these are returns which are competitive with the S&P, exceed most people's needs, and can be earned contractually and dependably. That's a damn good combination.
To private credit. Okay. So I was told not to hog all of your time, Howard. So audience questions, and So I was given this, so I'll give this back to you. Okay, we are going to be here for a long time.
Good. I look forward to it.
What are the most difficult things while being a contrarian?
You know, Dave Swenson ran the investment portfolio at Yale University from 1985 to 2020 when he passed away. And he had singular success. The reason is because when he got to Yale at 1985, he did heavy amounts of private equity, venture capital, and hedge funds at a time when other people didn't do it. He did it boldly, but he did it well. And he picked people who went on to have very substantial careers. And he was willing to make investments based on his intuition about those people. They didn't have the records. If they had the records, they'd be full of money, and they'd have so much money they couldn't perform well anymore. He got them early, and he did it boldly. And he wrote a book called Pioneering Portfolio Management around 98, and he included in there one of the great descriptions I ever heard. He said that investment management requires the adoption of uncomfortably idiosyncratic positions. Those two words, uncomfortably idiosyncratic, have years of wisdom in them. You can say them in a second, but they have years of wisdom. Idiosyncratic. This is very important. I talk in the book about second-level thinking. We talk about contrarian behavior. These are all interrelated concepts. The point is this. I was meeting with the university class last week in New York, and I said, who in this room has the goal of being average? And no hands went up. I said, who wants to be above average? Every hand went up. And I said to them, think about this. If you think about things the same as everybody else, and you have the same data as everybody else, which the SEC is determined to make sure that everybody has the same information, and you think about it the same and you process it the same, you'll probably reach similar conclusions, you'll probably take similar actions. That's not a very good formula for being superior. In order to be superior, you have to do something different. You have to diverge from the crowd. So that may be your contrarian behavior. Of course, you can't be a contrarian just for the sake of having contrary opinions. Your opinion has to be non-consensus and correct. Well, that's not easy, because all the other people who constitute the consensus, they're not dummies. And when people think that I'm the only smart one and everybody else an idiot, that's when you get into trouble. That's hubris. And so, oftentimes the consensus is as close to being right as you can get, and it's hard to consistently deviate from the crowd and be more correct. But that's what you must do in order to be a superior investor. Idiosyncratic and uncomfortable. If you're taking positions that are different from the positions of everybody else, why do they take those positions? They take those positions because they receive the same information you do. They're bombarded every day with the same newspaper news and broadcasts and emotional factors, and they reach a certain conclusion. And they're not dummies. And you reach a different conclusion, and you say, I'm going to distinguish myself through taking a non-consensus action. If you do something different from what everybody else is doing, and you're not a little bit uncomfortable, there's something wrong with you. Everybody else thinks NVIDIA is great, and it's up 6 times in the last 2 years. And you say, it's overpriced, I'm not going to own it, I'm going to short it. And if you do that and you're not a little uncomfortable, there's something wrong. Yeah. So I think that you ask, what's the challenge? You have to engage in uncomfortably idiosyncratic behavior, and you have to be right. You have to have a strong stomach. And the reason you need a strong stomach is because we sometimes know what's going to happen. We never know when. And the fact that you conclude that something is underpriced and it's a bargain and you buy it today, it doesn't mean it's going to start going up tomorrow. And you may have a long time to wait. The first of the great adages that I ever learned in the early 70s was that being too far ahead of your time is indistinguishable from being wrong. And so if you're a contrarian, you deviate from the herd, you do something different, it's uncomfortable, and you may have to wait a long time. And in that interim, you may look pretty bad. You have to have the intestinal fortitude to retain your position. You have to have an understanding with your bosses or your clients that permits you to do so and to get through to the other side when, if your decisions are correct, they're validated. But obviously, this business of departing from the crowd is not easy. And, and roughly 100 years ago, Lord Keynes said, it is better for reputation to fail conventionally than to succeed unconventionally, because unconventional behavior can cause you a lot of problem in the interim.
Interesting. I have a lot of questions around what's happening.
I'm going to try to shorten my answers so that we can get through some more questions. So let's make this a rapid fire round.
Right. So, what are your views on de-dollarization and the new world order, with different trading blocks being formed with new government political alignments? So this is basically any thoughts that you might have around not exactly what is going on with the world in general.
When he says what's going on with the world, you can spell that TRUMP.
Thank you. So how should one figure this?
Well, look.
Or sit on the sidelines and just wait?
No, you can't sit on the sidelines. If you sit on the sidelines too long, you're out of work. You can do that with your own money, but you can't do it too long with client money.
Yeah.
Because if you're ahead of your time, you'll look wrong for a good while. I still think that the U.S. is a good destination for capital, and we have we've been preeminent for 100 years, and the reasons are a combination of capitalism, free enterprise, innovation, and imagination, rule of law, vibrant capital markets, good management practices. The U.S. has a lot going for it, and that's not going to change overnight. And, as I travel the world and I speak to clients in Asia or the Middle East or Europe, most of them have little choice but to be heavily invested in the United States, and I think that's still true. And we're not perfect, and maybe we're a little less perfect than we were a few months ago, but nothing else is perfect too. What's better? And if you look for economic vitality and the other things that I named, where else can you find it? Where a better overall combination. So I think the U.S. is still prime as a destination for capital. What's going on in government right now, I think that President Trump, don't lose track of the fact that he is one of the most pro-business presidents that we've seen in decades, if not ever. He comes from the business world. We haven't had many presidents from the business world. He's a dyed-in-the-wool capitalist, and he truly wants to make the economy and business more successful. The issues around, obviously, his methods and his implementation, and he announces tariffs, and then he says he's not going to do it, and then he gets a concession, and he says, okay, that's done. Then he says, we are going to do it. Then he says, we're not going to. So, it's kind of a day-to-day presidency. And as a business person, he believes that unpredictability in negotiation is a positive. And he certainly intends to be unpredictable. And we know, that, and past presidents have been more predictable because we understood their ideology and we thought they were defined by a rather narrow and conventional probability distribution. Trump is not defined by a narrow probability distribution. But the truth of the matter is, if I want to buy this building from the people who own it, and I tell them in advance my price, the negotiations are not going to go too well. And so we're living in a world of uncertainty, unpredictability, and from time to time, maybe at this moment, it looks like that could detract from the desirability of putting capital in the United States. This will fluctuate. I think that a probability distribution that looks like this defines most people and most presidents, and the one that defines this president might look a little more like this. A lower level of likelihood for the things you think are most likely, and then some rather significant tail events that have some meaningful likelihood. And that we're just living in a world of uncertainty. But I believe that it's fair to say that the probability distribution that defines this president has a likelihood of tail events on both sides. His goals are good to have a more fruitful relationship with the world community than it has been. I think he thinks that the U.S. has been too generous.
Sure. Yes.
And the other thing is, he wants to make American companies more successful, which will come at the success of non-American companies. And he wants to get the federal budget under control. And we're running massive deficits in times of prosperity, which even Lord Keynes, deficit spending is called Keynesian economics. Keynes invented it or codified it. Even he didn't believe in running big deficits in times of prosperity. And Trump wants to get that under control. So these are legitimate goals. The questions are around the implementation. But if he can achieve these goals, that means positive tail events. And I think nobody should lose track of that.
Thank you for being direct and clear. Last question. Your insights have shaped so many investors and how they think, including many in this audience, I'm sure. So before we wrap up, if you could leave us with one lasting lesson as a student, one lasting lesson on investing, what should it be?
I think, first of all, it's an incredible thrill and reward for me to think that I've had a positive impact on people in this room and elsewhere. And I think I still believe so far that we only get one life, and the goal is to make it as good as possible. And my definition of a good life is having a positive impact on the world. And I'm not Mother Teresa. And I don't insist that people in the investment business are doing God's work. But I still think that if I can help people in the profession, it makes me happy. I would go back to what I said before. Think things through. Question your assumptions and question the rules that you're handed. And think about it hard and long and say to yourself, do I really accept this? And when I started in this business at Citibank in September of 1969, we invested in what were called the Nifty 50. Mm-hmm. These were supposedly the 50 greatest and fastest growing companies in America, which were so wonderful that nothing bad could ever happen, and there was no price too high. And if you bought the stocks today, I would report it to work, September 22, 1969, and you held them tenaciously and faithfully and loyally for 5 years, you lost about 95% of your money. And I was too young at that time to question. I hope that if I had thought about it, I would have questioned it, but I didn't question it. I accepted it. And these companies were selling at PE ratios between 60 and 90, and half of them ran into serious life-threatening problems. So don't accept, question to your own satisfaction. And it only by doing so can you become superior in this line of work. And we all should have the goal of being superior. Nobody should have the goal of being average. If you want to be average, I'll sell you an index fund for 2 basis points. And I can tell you, if you're average, you should not make a princely living. The other thing is that it's incredibly rewarding intellectually to think of things that other people haven't. And so always push the intellectual underpinnings of what you do. And, my son went off to college and he wanted to become an investor, and he would come home and he would say, "Dad, I think we should buy Ford stock because they're coming out with a new Mustang and it's going to be a great car." And I always asked him the same question to spur him on. I would say, who doesn't know that?
Yeah.
To be a superior investor, you have to know something everyone else doesn't. And the things that everybody else knows are probably already incorporated in the price of the stock. The market is pretty efficient. You have to rise above. Push your assumptions and don't swallow what you're told.
Thank you. Thank you, Howard, again.
I've 8 years ago, I felt a very warm welcome from the society here in India. I feel it again. I'm very proud to be here, and I hope my next visit is in 8 years from now.
Exactly.
I want to thank Venkat for doing a great job of interrogating me.
Gentlemen, thank you for a very candid and no-holds-barred conversation. It was a pleasure listening to you for the last hour. My key takeaway from this session is I'm buying an exercycle for my parents, right? And I ensure they use it as well. On behalf of the CFA Society, I thank you, Howard and Venkat, for a lovely session. And I thank the team at Oaktree Capital Management and CFA Institute who have been co-hosts for the event today. May I request you, Howard, to sign a memento for us on the easel? May I request Mr. Rajesh Sehgal, Chairperson, CFA Society India, Ms. Aarti Porwal, Country Head, India, CFA Institute, and Mr. Shamit Choksi, Director, Professional Learning, CFA Society India, to join us on the stage.